And moving on, Adani Ports has just come up with its Q1 numbers. Its beat across revenue and profit have both gone up by 21 and 46% respectively. Let's get in my colleague Anushi for more details on the stock. Anushi.
Hey Pallavi, so as you mentioned, in fact, Adani Ports have been a beat across all the parameters. I'll just talk about firstly the financial metrics over here. So revenue, we are seeing about a 21% growth, while EBITDA has clocked in about 29% growth. So both beating the Bloomberg estimates as we see. Now, it's the margins which are in particular focus, 64% as compared to 60.1% of last year. Now, this is a beat wherein the street had estimated about 59% of EBITDA margins, and a consequent result of this, we are seeing a net profit growth also of about 46.7%. So again, if you have to look at the about the EBITDAs and the why we are looking at this growth, so the company expanded that it is due to the better asset sweating which has taken place. Other than that, even if you look at the volume growth, so volumes have recorded about an 8% growth in this quarter. Do note that this is despite the company seeing a temporary disruption in its Gangavaram port in which it had recorded a loss, but now it has fully restored, so we see the normalized operations going forward. But again, to reiterate what is happening and what we should look forward to as per the company's FY25 guidance, revenue remains at about 29,000 to 31,000 crore, of which the company achieved the 7,500 crore as we speak. EBITDA in the range of 17,000 to 18,000 crore. Capex remains on the line at 10,500 to 11,500 crore, and the company maintains a net debt to EBITDA ratio of 2.2 to 2.5x, wherein in this quarter its net debt to EBITDA stood at about 2.1x. So this is on the overall side that we are looking in terms of volume growth, how the numbers have panned out for Adani Ports.
All right, thanks a lot for that, Anushi. And moving on from the markets to a quick macro check, manufacturing PMI figures came in earlier today morning, and for the month of July, manufacturing PMI stood at 58.1. That's compared to 58.3 in June. So not much of a change. And just for context, any figure above 50 indicates expansion. So the latest reading does continue to exceed the long run average and continues to remain among the higher readings that we have seen in recent years. What's responsible is buoyant demand conditions in the manufacturing industry, which is creating a ripple effect across the industry, mainly resulting in a substantial rise in new work intakes. Demand conditions being favorable and new orders coming in has also meant additional input purchases by goods producers for the month. The rate of expansion there again was sharp, with more than a quarter of the panelists polled for the survey raising their buying levels. What also stood out was that the overall rate